Good day, everyone. My report is on the Philippine Deposit Insurance Corporation, and the coverage of my report are as follows. First is the basic policy. Second, the concept of insured deposits. And third, the liability to depositors. So, to start, the concept of the PDIC law is synonymous to the concept of insurance, wherein in the concept of insurance, it originated from the fact that people are facing risk in life, risk in family health, damage of property, or financial loss. If the people are not prepared for these events, they will suffer. These events have long been recognized, and to protect the people from these events, people have come up with insurance. And through insurance, people are able to spread the risk to lessen the impact of loss. And insurance found its way in the banking industry since banks are susceptible from bankruptcy and closure. Since banks are susceptible from insolvency or closure, this might instill fear to the depository public, and this may lead to banking crisis. And when the Philippines suffered a banking crisis or financial crisis in the 1960s, this prompted the legislature to enact Republic Act 3591. So this is the original law that created the Philippine Deposit Insurance Corporation, provide deposit insurance coverage for the depositing public. And RA 3591 have undergone several amendatory laws such as RA 7400, RA 9302, RA 9576, specifically which increased the mandatory deposit insurance coverage from 250,000 to 500,000, and lastly amended by RA 10846. So as to the basic policy of the PDIC law, under Section 1, it is hereby declared to be the policy of the state to strengthen the mandatory deposit insurance coverage system to generate, preserve, maintain faith and confidence in the country's banking system, and protect it from illegal schemes and machinations. Of course, when a person deposits his money, it is presumed that it's his hard-earned money. Knowing that banks are susceptible of insolvency and bank closure, this will discourage a person to deposit his money in the banks, and this will affect the economy because banks creates money by using these deposits. And so, to provide remedy to this law, we have here its basic policy to strengthen the mandatory deposit insurance coverage system so that the depositing public would have confidence in the banking system. Okay, and it also protect the insured deposits from illegal schemes and machinations because there are unsafe and unsound banking practices. Okay, so toward this end, the government must extend all means and mechanisms necessary for the Philippine Deposit Insurance Corporation to effectively fulfill its vital task of promoting and safeguarding the interests of the depositing public by way of providing permanent and continuing insurance coverage on all insured deposits, and in helping develop a sound and stable banking system at all times. So this is the basic policy of the PDIC law. Let's proceed to the concept of insured deposit. As to Section 5, it defined insured deposit as the amount due to any bona fide depositor for legitimate deposits in an insured bank as of the date of closure but not to exceed 500,000 pesos. So bona fide means legitimate deposit or deposits made in good faith. So basically, insured deposit refers to the deposits made by a depositor in the bank. So these are the amounts deposited. So for an example, if an individual went to the bank and deposit money, so that now is the insured deposit. However, if the bank is closed or it suffered insolvency and it was closed by the Bangko Sentral ng Pilipinas, okay, the insured deposit should only be up to 500,000 as provided under Section 5. It will not go up. It is only limited to 500,000. So for an example, if an individual went to the bank and deposited an amount of 100,000 to a savings account and the bank suffered bankruptcy, so how much amount can the depositor recover from the PDIC? So it is only up to 100,000 because the 500,000 mandatory insurance coverage as provided here in Section 5 is only a ceiling. So the depositor can only recover up to 100,000 only. But what if his deposit is amounting to 700,000 and the bank suffered bankruptcy? Now the depositor cannot recover 700,000 because the ceiling is up to 500,000 only. So that is the concept of insured deposit. Okay, so these are the classification of insured deposits. As to deposit type, we have savings, special savings, demand or checking accounts, and certificate of time deposits. As to deposit account or kinds of deposit account, these are single account, joint account, account by, interest for, or for the account of. So next, here's a question. What if the depositor has more than one account in one bank? So the answer would be all deposit accounts by a depositor in a closed bank maintained in the same right and capacity shall be added together. Deposit insurance coverage is not determined on a per account basis. The type of account, whether checking, saving, time, or other form of deposit, has no bearing on the amount of insurance coverage. So this means that if an individual has two accounts in one bank, one is savings account and the other is time deposit account. Does it mean that these two accounts are separately insured by the PDIC? The answer is no. As stated in here, those accounts maintained in the same right and capacity shall be added together. So these two accounts, the saving and the time deposits, would be consolidated in one. So it can these two accounts can only be insured by the PDIC up to 500,000 only. Like for example, in the savings account, if it is amounting to 500,000, the deposit account is amounting to 500,000. The depositor owning these two accounts cannot recover 500,000 separately because the separate accounts is consolidated in one, so the depositor can only recover 500 up to at least 500,000 by those accounts. So the next question is, how shall joint accounts be treated? Joint accounts shall be insured separately from any individually owned deposit. So in one bank, if a depositor owns a single account, okay, and a joint account, these shall be treated separately. So the depositor can recover, okay, upon the closure of the bank, a separate 500,000, okay, ranging from zero to at least 500,000 from the single account, and separately can recover from the joint accounts, okay, up to 500,000 separately. Okay, so next, What if the depositor has more than one account but in different branches of the same bank? Okay, the answer would be if a bank has one or more branches, the main office and all branch offices are considered as one bank. Thus, if you have deposits at the main office and at one or more branch offices of the same bank, the deposits are added together when determining deposit insurance coverage, the total of which shall not exceed 500,000. So, if the depositor has different accounts in one in the main branch and into the other branches, this can only be consolidated as one. So the depositor can only recover up to 500 mandatory insurance only because it is consolidated as one. Next, what if the depositor has more than one account but different banks? So here it is different because we're now talking of different banking institutions. So the answer would be deposits in different banking institutions are insured separately. Then what is required before one can be recognized as a depositor who is entitled to avail of the benefits of the law? According here, no owner or holder of any passbook, certificate of deposit, or other evidence of the deposit shall be recognized as a depositor entitled to the rights provided in this act, unless the passbook, certificate of deposit, or other evidence of deposit is determined by the PDIC to be an authentic document or record of the issuing bank. So for a depositor to be entitled of the insured deposits, he or she must present evidences such as passbook, certificate of deposit, or other evidences which is authentic or legitimately recognized as an authentic evidence by the PDIC, so long as this has been determined by the PDIC to be an authentic document, then a depositor can be entitled to avail of the benefit of the PDIC law. So, can the 500,000 maximum coverage be adjusted without an amendment of law? The answer is yes, so long as there is a condition that threatens the monetary and financial stability of the banking system that may have systematic consequences. So, they can increase this 500,000 so long as there is this condition that threatens the monetary and financial stability, but subject to the determination of the Monetary Board as chaired by the Secretary of Finance, and lastly, by the approval of the President of the Philippines. So the next coverage or the last coverage is the liability to the depositors. So where does PDIC get the premium? So in insurance law, uh, the agreement between the insurance company and the insured, the payment of premium is made by the insured or the party itself. While in here, how about if it is between the depositor and the bank? Who will pay the premium? The answer is that the bank will pay the premium and not the depositor. Okay? So it collects premiums from the banks, not from the depositor or client. It is based on a certain percentage of total deposits. It is one-fourth of 1%, so that is 0.25%. Every year, PDIC collects premium from the bank to ensure their deposits dependent, their deposits dependent on the amount of all the deposits. If the bank collapses, then the depositor can file the claim with the PDIC. This is the concept of PDIC. It insures your deposit even without you paying the premium, which is paid by the bank. Next, when is the PDIC liable? PDIC can only be liable if the insured bank actually first receives the deposit. Second, the bank is ordered to be closed by the Bangko Sentral ng Pilipinas. And To support this or in consonant with this are the conditions to make PDIC liable. But first, the bank must have received deposits. The second, the bank became insolvent or closed because of insolvency. If the bank is operating in good condition, you don't go to the PDIC, you go to the bank to get back your money. Next question, what are the requisites in order for the deposits to be covered by the insurance? First requisite is that the unpaid balance of money or its equivalent received by a bank in the usual course of business and for which it has given of is obliged to give credit to a commercial, checking, savings, time, or thrift account. Second, it must give rise to creditor-debtor relationship between the bank and the depositor. So here it is the bank who will be the debtor and the depositor and the person who deposit would be the creditor. Okay, the debtor refers to the bank and the creditor refers to the depositor. So next, what is the rule in case of deposits in a branch of domestic bank outside the Philippines? The rule is that deposits in a branch of the domestic bank outside the Philippines shall not be covered unless the insured elects to include the same for insurance subject to approval of the PDIC. Basically, this means that if there is a banking institution here in the Philippines and it is the main branch and it has branches located outside the Philippines, the main branch automatically, of course, is insured by the PDIC. But what about those banks located outside the Philippines? The general rule is that they are not covered by the PDIC. Exception is if the main branch or the main office elect those branches located outside the Philippines be insured. Exception is if the main office elected those branches outside the Philippines be insured. Okay, so that is the end of my report. Okay, thank you.